Welcome to Talk Tickers. We're the show that cuts through the noise of earnings calls to give you the essential insights.
That's right. And today, we're doing a deep dive into Canaan Inc., their first quarter 2025 earnings call.
Yeah, and the story management told, well, it was dominated by trying to navigate some really extreme market volatility, especially with Bitcoin's price all over the place.
And facing some significant, headwinds from those new U.S. tariff measures. That was a huge theme.
Definitely. Management also, they didn't hold back on their stock valuation. They think it's significantly undervalued.
Right. And they mentioned they're looking at strategic initiatives, possibly even a share repurchase program.
So here's how we'll unpack it for you today. We'll start with a quick snapshot of the key results, just the headlines.
Then we'll dig deeper into the operational and financial details, putting it all in the context of that challenging environment they described.
We'll talk about what it means from an investor perspective, and then wrap up with our not financial advice segment.
Yes, where we pitch a speculative, maybe outrageous, but plausible trade idea using only what we heard on the call.
Exactly. So let's jump right into those key results.
All right, so Q1 2025 numbers for Canaan's. Total revenue landed at $82.8 million.
Okay.
And what's notable here is that this actually beat their previous guidance. They'd guided for $75 million.
So a solid beat right off the bat.
Yeah, and it's a huge jump year over year, like a 136% increase compared to Q1 last year.
Wow. Okay, so breaking that down, mining revenue.
Mining revenue was $24 million. That came from mining 259 Bitcoins in the quarter.
Which is up quite a bit, quarter over quarter.
It is up 39% on the Bitcoin mine compared to Q4. And that translated into a 132% year over year jump in the actual mining revenue.
Got it. And the bigger piece was machine sales.
Yeah, machine sales brought in $58.3 million. They sold about 5.5 exahashes per second EHs in total computing power.
Okay, and how does that compare?
That's up 63% year over year in terms of the power sold. So decent growth there too.
And a key driver for that machine revenue seems to be the price they got per unit of tower, right? The ASP.
Exactly. The average selling price per terahash hit $10.05.
$10.05? That sounds like a big jump.
It is. It's up 53% from Q1 of 2024. So yeah, suggests either better demand for their newer stuff or maybe just better pricing power overall.
Interesting. And profitability. I heard that was a milestone.
Yes, a significant one. They achieved positive gross profit, $2.6 million. It's the first time they've done that since the crypto bear market really kicked in 2 years ago.
Right. So turning a corner there, at least on the gross level, what about expenses?
Some good news there too. G&A, general and administrative expenses, actually decreased by 39% quarter over quarter.
Okay, so cost control helping out.
It seems so. And that helped narrow their operating loss quite a bit, down to $37.6 million.
Still a loss, but better.
Much better. It's a 32% improvement from Q4 and 45% better than the loss they posted in Q1 last year. So the trend is definitely heading, in the right direction.
Okay. And their cash situation?
Pretty stable, actually. Ended March with around $100 million in cash.
And they're still stacking sats, as they say, holding Bitcoin.
Oh, yeah. They continued that strategy. Their holdings hit a new record, 1,408 Bitcoin by March 31st.
And even more after that.
Just slightly. Up to 1,424 by April 30th. And they did point out that with Bitcoin recovering, above $100 K by the time of the call, the fair value of those holdings looked a lot healthier than at the March low point.
Okay, so that's the snapshot. Beat revenue, back to gross profit, shrinking losses, growing the Bitcoin stack. Seems pretty decent, like on paper.
Right. But, and this is a big but, management spent a lot of time talking about just how difficult the environment actually was.
Yeah, let's unpack that. The challenges they face in Q1. Starting with the macro stuff, those tariffs, that sounded messy.
Absolutely messy. Q1 was incredibly complex on that front. The U.S. tariff situation just kept evolving. You had 10% on Chinese goods in Feb.
Which they doubled.
Doubled to 20% in March.
Nice.
And then April, a whole new thing. A 10% universal tariff on imports from all countries.
Wow, okay.
And on top of that, potentially much higher, like up to 145%.
Yeah.
Reciprocal tariffs, specifically on Chinese goods.
And China hit back, presumably?
Of course. Retaliatory tariffs, export controls on U.S. goods. It was, a rapidly changing trade war dynamic.
So not just one tariff, but like layers of them. And all this while Bitcoin itself was volatile.
Extremely volatile. They pointed this out specifically. Bitcoin fell from around 104K end of Jan down to 76K early March.
Ouch.
Then it clawed back a bit, maybe 85K late March. Dipped again to 74K early April.
Before recovering strongly?
Yeah, before recovering strongly, back above $100 by the time they held the call. But that's a wild ride for miners.
For sure. And the crazy thing is, even with those price drops, the competition, the network hash rate kept going up.
Exactly. It rose throughout Q1 from about 795 exahashes to 856.
So you've got falling prices, rising competition, squeezing margins.
Precisely. Miner profit margins got really compressed across the board, and then you layer these new U.S. tariffs on top for anyone bringing machines into the U.S.
Right, because Canaan makes their machines mostly in Southeast Asia.
Largely, yeah. So those machines suddenly faced at least a 10% duty coming into the U.S. market. Plus potential tariffs on other stuff you need for mining sites, like power infrastructure.
And they said the way these policies changed was also a problem, like the speed and inconsistency.
Yeah, they emphasized that. It created a lot of uncertainty, confusion. They mentioned inconsistent customs enforcement, unpredictable clearance times.
Which means higher costs, longer waits, more headaches, specifically for U.S. miners.
Exactly, compared to miners elsewhere. And the direct result, according to Canaan's management, was that U.S. demand for mining machines got suppressed in Q1.
Okay. And that pressure in the U.S., it seems like it's pushing some U.S.-based miners to look at other things like AI or high-performance computing.
It seems so. Canaan CEO actually commented on that trend among their customers.
What did he say?
Well, he was pretty blunt, actually.
Huh.
He called those efforts an experimental quick fix.
Ooh. Okay, so not seeing it as a real long-term solution?
Doesn't sound like it. The implication was that Canaan still sees Bitcoin mining as the core strategic play, not these diversifications into AI HPC as a fundamental shift.
Interesting perspective. Okay, so that was the storm. How did Canaan's actual operations hold up inside all of that?
Well, despite everything, they reported pretty solid operational execution. Their A15 series rigs were the main engine for machine sales growth.
And those newer A15 models helped with that higher average selling price we talked about.
Yes, exactly. Better efficiency, newer tech, commanding a better price. That definitely helped lift the ASP.
And they mentioned demand outside North America.
Yeah, they highlighted that specifically. Said demand continued to grow strongly in places like Asia, South America, and Africa. Saw good momentum there. And maybe a bit of a surprise, their Avalon Home series did well.
The one for individuals?
Yeah.
With heating?
Yeah, that one. Dual mining and home heating. Apparently it performed better than they expected. Exceeded internal targets.
Okay. What about their own mining operations, the self-mining?
They said results there were strong. Attributed it to growing their energized hash rate, basically getting more of their own machines running and optimizing their projects.
Did they give numbers on costs or margins?
They did. Achieved a pretty competitive electricity cost, 4.2 US cents per kilowatt hour in Q1, and maintained a solid 31% mining gross margin.
That's pretty good. And they're still deploying more capacity.
Steadily, yeah. By the end of April, their total deployed computing power hit 8.15 exahashes. And importantly, 3 EHs of that is fully deployed across 4 projects right here in the U.S.
And on the tech side, improving the A15s.
Continuous work there. They worked with their foundry partners, got chip yields over 90%, said overall machine performance improved 15%, and power use dropped 10% from the initial design.
Any new cooling tech?
Yeah, they introduced more advanced products using hydro and immersion cooling, like the A1566 AJ model, which gets around 500 terahashes per unit with better energy efficiency.
And looking forward, the next generation.
Yeah.
A16.
A16 series completed tape-in, which is a key design step, in Q1. Expected to launch after testing, promising, significant performance upgrades.
Okay. Shifting gears a bit, production and geography. Manufacturing outside the U.S. helped with tariffs.
Definitely helped cushion the blow, yeah.
Yeah.
Diversifying manufacturing to Southeast Asia was a key part of their strategy there.
But here's where it got really interesting, strategy-wise. They started a pilot production line in the U.S.
That's right, late in Q1. And they said trial production was successful. So U.S. manufacturing, at least on a small scale, is, quote, essentially up and running.
But expensive. Right?
They were upfront about that. Current U.S. production costs are high compared to, say, Malaysia, but they see strategic value.
Like being closer to customers, reducing supply chain risks.
Exactly. So they're actively looking into a larger U.S. facility, trying to figure out how to cut costs. They have an internal goal. Keep the cost increase versus Malaysia under like 15-20%.
But that depends on demand.
Heavily. They basically say in the Q&A, it depends if the U.S. market rebounds enough to actually support that higher cost structure. It's a tricky calculation for them.
Makes sense. And that positive gross profit we mentioned earlier, do they connect that to operational stability?
They did. Linked it back to improving key indicators across the business over the last couple of years.
Yeah.
Just getting more stable and efficient overall.
Okay. And even though the Bitcoin price dip caused that paper loss on their holdings.
Yeah, the $16.3 million unrealized fair value loss.
They're sticking with the holding strategy.
Absolutely. Reiterated strong commitment, belief in long-term appreciation. And they were quick to point out the price recovery by the call date had already wiped out those specific Q1 unrealized losses on paper.
Okay, let's touch on the balance sheet and financing quickly. Building inventory.
Yep, building up inventory of the new A-15s for deliveries. Cash, stable around $100 million, as we said.
And they bought the dip on Bitcoin too.
Strategically, yes. Use the Q1 pullback, bought 27.46 Bitcoin at an average price of around 83K. So adding to their stack at what they saw as a good price.
Okay, cash flow in Q1, where did money come from? Where did it go?
Generated $51 million from sales, got $21 million from secured loans, and $18 million from export VAT refund.
And outflows.
Spent $88 million on production and operations. And then a big chunk, $144 million, specifically to secure wafer supply for future chip production.
$144 million on wafers. How'd they fund that?
Mostly from financing. They closed a $100 million Series A1 preferred share round in March, and they raised another $42.5 million from an ATM program they ran late last year into Feb this year.
Right. They also mentioned terminating an agreement for a second $100 million tranche of those Series A1 share.
We did. Mutually agreed to terminate that, effective April 30th.
Any reason given on the call for why that second tranche went away?
Not explicitly. Just said the decision was mutual. Could be they felt they didn't need it immediately given the other funding, or maybe the terms weren't ideal anymore with the market shifting so fast. Just means that specific $100 million isn't on the table right now.
Got it. And using their Bitcoin holdings for liquidity.
Yeah, they pledged 900 Bitcoin carrying value around $45 million for secured loans. So the interest rates were reasonable, provided extra cash. Another 100 BTC were in some kind of fixed term product.
So leveraging the asset without selling.
Seems to be part of their holder strategy, yeah. Exploring ways to use the crypto for liquidity.
Okay, let's turn to the outlook. Guidance. What's the picture there? North America.
Still looks tough. Management said demand there remains under significant pressure. No clear signs of recovery yet.
And they're blaming the tariffs and the impact on financing for U.S. miners.
Directly, yes.
Yeah.
Said U.S. customers are mostly in a wait-and-see mode. That's leading to delays, adjustments to orders, and delivery schedules. Even their joint mining projects in the U.S. are facing higher costs and delays because of tariffs.
So, given all that uncertainty, they pulled guidance.
They did. Explicitly withdrew their previous full-year revenue guidance and their H1 2025 targets for deploying their own mining hash rate.
Focusing on flexibility instead?
Yeah, pivoting quickly, responding to fluctuations. That's the new focus.
And shifting their own mining expansion more globally.
Actively doing that.
Yeah.
Pursuing global opportunities. Express confidence in finding partners outside North America, too.
They mentioned Ethiopia as an example.
Yeah, highlighted it as proof they can execute globally. Pointing to really good uptime numbers there, 98% in Q1, 95% in April, even with local challenges. Shows the value of geographic diversification.
Okay. What about Q2 specifically? Any expectation there?
A cautious one. They anticipate Q2 revenues around $100 million.
But with caveats.
Big caveats. Stressed very carefully that actual results could be significantly different because of all the policy uncertainty and market swings.
Right. And they kept coming back to their stock price.
Yeah, circle back to it. Reiterated their belief. Stock price is significantly below intrinsic value, long-term potential. And they explicitly linked that gap to how the market's perceiving the impact of those U.S. tariffs.
Which is why they're considering a share buyback.
Exactly. Evaluating strategic initiatives, including a potential share repurchase program, as a way to address that perceived undervaluation and boost shareholder value.
Okay. And they promised to keep the market updated.
Yep. Said they'll inform on material developments, stay focused on tech, products, customers, and that global strategy.
Now, the Q&A often adds some good color. What came out there? Like, why did the ASP jump so much in Q1?
Good question. They said it was a mix. Strong sentiment early in Q1 helped. Good feedback on the A15 regs. Also, they had to prioritize urgent orders, which let them raise prices a bit. And clearing out older A14 inventory probably helped the average later in the quarter.
And Q2 ASP, likely higher still.
They expect it to improve further, yeah. Because contracts locked in April and May for the A15 were apparently at higher prices than the earlier Q1 deals. Plus, less of that older A14 stock dragging the average down. But longer term, Q3, Q4,
More cautious.
More cautious, yeah. Could be flat, maybe even slightly lower if U.S. demand stays weak and Bitcoin price doesn't rise significantly to kind of, offset that pressure.
Got it. And the CEO's take on U.S. miners exploring AI HPC.
He doubled down on that experimental quick fix comment from the prepared remarks. Still doesn't sound convinced it's a major strategic shift. Okay.
And self-mining expansion, confirming the U.S. deployment, but focus shifting outward.
Exactly. 3 EHs deployed in the U.S. by end of April, but yeah, the focus is definitely shifting due to the U.S. situation. Highlighting projects like Ethiopia, again, avoiding policy risk, low power costs, high uptime. They're looking at scaling existing non-U.S. sites and talking about new ones globally.
They compared May versus April orders too, didn't they, in light of tariffs?
They did. Said sentiment was better in May because Bitcoin recovered, but that minimum 10% extra cost from tariffs is still a real drag on U.S. miners' competitiveness.
And here's the kicker, right? The non-U.S. sales.
Yeah, this was really telling. They said sales volume in non-U.S. regions just by the middle of Q2 had already matched the entire volume sold in non-U.S. regions during all of Q1.
Wow.
Directly linked that surge to Bitcoin recovering above $100.
Yes.
And importantly, they said they saw no improvement yet in U.S. region sales over that same period.
Okay, so that just hammers home the point. Global demand snaps back with price. U.S. demand stays stuck because of tariffs.
Precisely. Really highlights how their global strategy is playing out right now. Quick note on lead times, down to 6 to 8 weeks now because they built inventory. Better than the 3 to 5 months before.
Yeah.
Aiming for 1-2 months eventually.
Okay, what about CapEx, especially that big wafer spend?
CapEx is mostly wafer prep and machines for self-mining. Q1 wafer spend was $144 million. They're continuing to invest in Q2.
How much for the full year on wafers alone?
Likely over $400 million. It's tied closely to revenue because those wafers become machines they sell or use themselves. Total CapEx for the year. Uncertain, depends on demand and tariffs, but expected to be higher than that $400 million wafer number.
But why commit so much to wafers now with all the uncertainty?
Yeah, good point. Management stressed it's about long-term foundry partnerships, locking in capacity with prepayments. They think current supply gets them through Q3, maybe Q4 with optimizations.
So it's a bet on the future.
Kind of. They're watching closely. The thinking is, if tariffs stabilize, market clears up, Bitcoin moons, financing comes back, then machine supply could get tight fast.
Having those wafers secured means they can ramp up orders quickly because foundries apparently still have some year-end capacity.
The strategic gamble. Okay, last bit from Q&A. That U.S. manufacturing pilot. Successful, but complicated and costly.
Exactly. The process works. They're making PCBs, soldering in the U.S. But planning tariffs on all the imported components they need is apparently a nightmare. Policies change daily. That 15-20% cost increase goal versus Malaysia is tough. So building a bigger U.S. factory really depends on
economics, purely. Does strong U.S. demand come back and justify paying that higher cost? It's a dilemma for them.
Right. Any final tidbits? Energy prices, site acquisitions.
No major changes on energy prices at current sites. Some optimism. Maybe future U.S. policy could free up more energy supply long term. Didn't really say if tariffs make U.S. sites more or less attractive versus global. Again, it's all about the overall economics. And no mention of tariffs pushing them towards AI HPC either.
Okay, that is a really comprehensive look. Results, the crazy market, their operations, the strategic moves, the cautious outlook paints a clear picture. Executing well, diversifying, but really wrestling with that U.S. policy uncertainty.
Yeah, and they clearly feel the market is maybe focusing too much on just that one piece, the U.S. tariff issue.
Which naturally brings us to
our not financial advice segment.
Exactly. Time to shift gears. Now remember, everyone listening, this whole discussion is just us analyzing an earnings call for informational purposes only. This next bit is pure speculation.
Purely. We're pitching an outrageous but plausible trade idea to an imaginary investment committee based only on what we heard in this Canaan's call.
This is absolutely not financial advice. Investing here is super volatile, super risky. Do your own research, your own due diligence. Seriously.
Okay, disclaimer delivered. Speculative hats are on.
All right, committee, here's the pitch straight from the Canaan's call. Management says, point blank, their stock's way undervalued. Why? Because the market's fixated on these U.S. tariffs.
But what did we hear on the call? They beat revenue guidance. They hit positive gross profit first time in 2 years. They grew their Bitcoin stack, which is substantial.
They're diversifying globally, and we saw that huge jump in non-U.S. sales just in the first half of Q2 when Bitcoin recovered. Demand is there outside the U.S.
And they're even taking steps to potentially mitigate tariffs long-term with U.S. manufacturing, if the numbers work out. Plus, they guided Q2 revenue around $100 million, albeit cautiously.
So the speculative trade idea, go long Canaan stock.
The thesis being,
The thesis is betting the market is overreacting to the U.S. tariffs, underestimating their operational strength, underestimating how well their global diversification is already working.
underestimating the potential value in that big Bitcoin treasury, maybe.
Yeah.
And the positive signal a share buyback could send.
Exactly. The outrageous part is believing they can navigate or offset this U.S. headwind better than the market thinks.
How could that happen? Maybe global growth just carries them. Maybe U.S. manufacturing works out eventually. Or maybe Bitcoin just goes on a sustained tear, lifting all boats and making the U.S. issue seem smaller in comparison.
Right. Remember, they said they have wafer supply secured, ready to ramp up if demand returns globally. Capacity isn't the issue if conditions improve.
So it's basically a bet on management being right, that the stock is mispriced because of this one regional headwind, and the market's missing the bigger picture. The global strategy, the operational improvements, the Bitcoin leverage.
A potential share buyback would just amplify that return if they are right about the undervaluation.
Yeah, definitely a high-risk, high-reward scenario based purely on the call narrative. Assumes the tariff issue isn't permanent or as damaging as feared, or that other factors outweigh it.
And with that speculative pitch, we wrap up our deep dive into Canaan's Q1 2025 earnings call.
We covered quite a bit. That revenue beat, the return to gross profit despite the market chaos and tariffs.
Walk through their strategic moves, global diversification, U.S. manufacturing exploration, stacking Bitcoin, and their cautious outlook, pulling guidance due to that uncertainty.
So one last time, folks, this discussion was analysis for information only, not financial advice. Bitcoin mining, this whole sector is incredibly volatile, huge risks involved.
Market swings, policy changes like we discussed, execution risk, tech risk, competition. It's all there. Please do your own thorough research before making any decisions.
Yeah, use what we talked about today as maybe a jumping off point for your own investigation if Canaan's or the mining space interests you.
And finally, here's something to think about, directly from what management said on the call. They believe their stock is undervalued, mostly because of the U.S. tariff situation. They're responding by exploring U.S. production and maybe buying back stock. So the question is the market currently putting too much weight on that tariff uncertainty?
And maybe overlooking their operational resilience, that accelerating global strategy, and the potential value locked up in their Bitcoin.
Something for you to mull over.